All right, let's get into the final segment on the rapid fire, record breaking, global macro, I told you so section of the show. We're going to start, Patrick, right out of the gate. Calgary has hit a new record breaking benchmark price has just hit $550,800. We don't have a chart on this, but it just happened. It's like hot off the press.
Hot off the press because there is no chart on it yet, and given it's so early in May. So long story short, JG, we've been talking about Calgary specifically for 3 years. I mean, more than that, but we cranked it up the past 3 years, and certainly driving people to our trusted partners in Calgary to make sure that they're getting deals done. No surprise that we're hitting these kind of numbers.
Next, Patrick, rents have hit a new record. The National Rent Index has accelerated in March. It's now up 10.8% year over year. When the market is going down, rents are going up. We called this one too.
We did. We keep talking about it. It's like every couple of weeks, every month, we're saying, listen, rents have nowhere to go but up. Demand continues. Unemployment is low. Population growth is high. GDP still continues to be positive, although I know we're trending a different direction. At the end of the day, rents have nowhere to go but up, given the fact that supply is not even there. Having said that, when you get into apartment styles, we're starting to see supply increase quite dramatically, as a matter of fact, and we're not seeing that in other property types.
Interesting though, Patrick, I just want a fun fact on this, because if you look at this chart that we have on the screen here of average asking rent, you can see how from 2020 to 2021, it was on its way down. That was because of COVID and because of the great Canadian migration, people moving away from downtown centers into other centers. And as a result, because the urban centers are so densely populated, their rents were coming down. So the rents of condos in Toronto and Vancouver, so on and so forth, were coming down. Therefore, the average rents were coming down. Not all property types, but those were coming down. The point there, Patrick, is some people were saying, oh my gosh, this will never come back. I mean, I'm out of that game altogether. We've seen them come back quite strong, in fact, and rents are now beyond where they were pre-COVID in just about all of those markets. And that's something to be said, Patrick, because people often think in absolutes and they think too short term. What's happening today, is, and they were thinking that during COVID, is it'll never come back. It did come back, and now they're back on a tear in all markets across Canada.
Well, and I think that we have to add on here, JG, and I don't know the impact of it, it's just anecdotal anyways, but just think about how many regions have and or are shutting down short-term rentals. So when you look at that whole short-term rental game and the movement of people around it, that also has an impact. So I think that we're destined for higher rents, and I don't think there's going to be anything stopping that. I don't think it's going to be dramatic, and they will go through plateaus and level out. But ultimately, there's a lot of causes to that, not the least of which is, of course, supply or lack thereof.
Rapid fire number 3. I'm pretty sure you wrote this headline, Patrick, because it says, West looks best. And of course, that would be Mr. Alberta himself writing those show notes, I have no doubt. But we have a great chart here, Patrick, about the economic growth. 22 economic growth in line with expectations. Saskatchewan, Alberta, Manitoba, BC, all ahead of Ontario, albeit Ontario looks a little ahead of BC there, Patrick, according to this chart.
Well, you know something, I look at what's going on with this, and, as much as this is rapid fire, and you did add to that the point that we get to say we were right, which is sometimes nice to do, given how many calls I've made that were they were right, but they were wrong in terms of timing, and some wrong calls for sure. But when you start to see that this is in fact what we've been talking about, and it is coming to fruition, the economic fundamentals don't kind of lie. They tell you where things are going into the future. And that's why we keep talking about this stuff. And hopefully investors are actually not bored with it and going, blah, blah, blah. No, this matters. This is why if you were investing in Calgary 3 years ago, 2 years ago, a year ago, as an example, you would have been doing very well.
All right, Patrick, for our next rapid fire, we have the third official U.S. Bank collapse, which is First Republic has now conceded. It's JP Morgan, I believe, has purchased all of its deposits, which you could speak to. But that's number 3 now in the U.S. Silicon Valley Bank, Signature, and now First Republic. Albeit this wasn't much of a surprise, Patrick, because I think from pretty much the get-go, they thought that First Republic was going to go down. It's just now official.
Well, we knew it was going down because Jim Cramer said it was the perfect time to buy into First Republic. So we know that it was going away. Here's the concerning part of this. There's lots of concerns about all of this, by the way, and that is that just these three banks alone have surpassed what the cost was of banks shutting down in 2008. And by the way, the number I got was 147 banks shut down through the 2008-09 financial crisis. And keep in mind that a lot of these are quite small banks with, you know, only a few billion assets on their balance sheets. But the point is that we've now exceeded that with just three banks. They are very concerned about what they're referred to as contagion, by the way. And this goes back to what we talked a little bit about what's happening in the commercial lending space, where 85% of commercial lenders in the US are these small banks. So it seems like the smaller banks are going away if you're listening to the narrative of what's going on in the US. And of course, a JP Morgan just got bigger. They got handed a sweetheart deal with the support of the Fed, with the support of the government, and they took over First Republic and over that balance sheet. But they got the pot sweetened in a couple of different ways. So it's all to say the bigger banks or the too big to fail banks continue to get bigger, and the small banks seem to be going away. That's a U.S. thing. What we don't know is what is the downfall or the fallout, if you will, I guess is a better way to say it, of what that means to us in Canada. The thing that we do have to keep in mind is that Canadian banks do have money globally kind of out there. And so that could be a bit of a blowback, a little bit of a ripple effect with what's happening in Canada banking system. Not a big concern, other than Mr. Trudeau recently did a little bit of risk mitigation and put some policies in place in the banking system, which is to say, if things go south, there can't be a run on the bank. So that was a new thing, and that just happened. And so prudent, but we never had that before.
Interesting. Rapid fire number 4 is some stats came out for Toronto, the Toronto market. I think this is quite indicative of many markets across country, Patrick, which is sales are down, new listings are way down. Like sales are down by 5%, 5.2%. New listings are down by 38.3%. I mean, we had a supply issue, Patrick, last year. Remember? I mean, we had a supply issue in 2020, 2021, 2022. We kept saying we need more supply. We need more new listings. We had an issue then. They're down 38.3%, which is a lot. Active listings are down 20.8%. The average price is down 7.8%. That, by the way, is not everywhere. This is just specifically Toronto numbers. And then the average listing days on market is up 54%, and the average projected days on market is up 71%, meaning we're projecting it's going to get a little bit worse from the days on market perspective. So that's the stats for Toronto and kind of indicative of many markets across the country.
It's pretty much indicative of every market across the country to some level. The point is that there just isn't listings. I think every realtor in the country, every brokerage in the country is waiting for spring to spring, and it hasn't sprung, and we don't have a big barrage or a big a large number of listings coming to market. And it's interesting about that, nobody really is everybody's trying to figure out the psychology about it. Why the psychology of people not listing? Why are they not selling? And then of course they say, well, because there's nowhere to buy. Okay, got it. But that is self-fulfilling prophecy in terms of, okay, I won't sell until somebody else sells so that I have something to buy. I don't know the psychology of it, to be honest with you. We just see it, and everybody's waiting around for supply to all of a sudden start to surge. At some point, we think it will. Most think it will. We just don't know what's going to open up that door.
Yeah, well, waiting and is certainly interesting, Patrick, because we see a lot of real estate investors on the sidelines, hoping, praying, and waiting, which are 3 tactics and strategies we don't think work ever. So just be careful about that. If you're hoping, waiting, or praying just for real estate, that's very just find a better tactic.
We need a better strategy.
Next on the rapid fire, Patrick, is Canadians' indebtedness returns to historically high levels. This chart just shows that essentially we are back to 180%, albeit, pre-COVID, it was about there. If you look at this chart, it's kind of like this has pretty much been our average since mid 2015, according to me. There's a huge drop because of COVID, but this just feels like clickbait to me. RBC Economics, bad on you,
Yeah, I
clickbait.
don't think it doesn't even have to be considered. It doesn't even have to be considered clickbait, JG. At the end of the day, what we know, and I keep going back to, here's the concern with all economies, and that is that we're debt driven. And this is a concern not just for Canada. So when we start to see people reach this level of debt and we consider the interest rates, what we start to see is that at certain levels of income, in that lower income tier, we are seeing people spend less. They're actually not putting their hand in their jeans and buying stuff, starting to see parts of retail slow down. At the other end of that scale, when you look at collector items and collector cars and exotic cars, those markets are still off the charts. People are spending a lot of money in those higher incomes. They continue to build their asset base, if you will, and spend money on collector things, including collector cars. So all to say that the debt level continues to go up. That's part of what drives this country's economy. So if it starts to slow down, there's where we see some risk to the economy. If you like what you learned here, go to the description below and subscribe for our free Insiders newsletter, where you can also stay up to date for our upcoming events and our courses.
If you want to see more stuff like this, click here. If you want to see the entire show, click there.